Hello everyone, this is Florian Munch from Mining Scout. Today I have a special guest out of the oil and gas industry, an industry veteran, Dr. Paul Clark. Paul, nice to have you here in the interview.
Excellent. Pleased to be here, Florian. Thank you very much.
Paul, you've worked with Chris Cornelius together in the oil and gas development for a long time. So tell me something about your track record. So where are you coming from? What are you looking at?
I'm the Vice President of Exploration with CanCambria. By background, I'm a petroleum geologist. I have around 25 years industry experience. I was educated in the UK. I have a first-class honours degree in geology and a PhD in petroleum geology from the University of Birmingham. But the majority of my career has been spent in the US working unconventional assets for medium and large size independents. Chris Cornelius actually brought me to the US to work with a company he was part of in the early 2000s called Evergreen Resources. A pretty big project on the NASDAQ then, the coal bed methane player that had a pretty good growth story and ultimately sold out to a company called Pioneer Natural Resources. They were acquired for around $2 billion in and around 2004, 2005. My journey in oil and gas, I stayed on with Pioneer. We were in Denver, moved to Dallas to their corporate headquarters and spent 15 years with Pioneer in various roles. Ultimately, I was their geoscience and subsurface director for two of the key assets, the Eagle Ford Shale, and then more recently the Permian Basin, which I'm sure a lot of folks are very familiar with. Exxon recently acquired Pioneer for a significant multi-billion-dollar transaction. At that point, Pioneer was a pure play Permian Basin company.
Okay.
So back in 2011, 2012, I was part of the team that put together the Eagle Ford Shale. I did all of the characterization, appraisal, and planning on the technical side for the company. We drilled around 150 or so horizontal wells, and we took that asset from zero production to something pretty sizable over a relatively short 2 to 3 year window. The stock price for the company went from around $40 per share up to $100. We then took that same team over to the Permian Basin and really did the same thing, the same exercise, appraisal, net asset valuation from geologic products, subsurface products, and then we kind of stepped up the stock price for Pioneer from $100 to $200 as they consolidated into the Permian. So that was a really interesting and exciting time in my career. A lot of drilling, a lot of fast-paced operations. In 2018, I moved to a company called Ultra Petroleum. They were and still are the largest natural gas producer in the state of Wyoming. They hired me in to transition some of their operations from predominantly vertical well drilling in Pinedale, which is a giant natural gas field, and they were hoping to drill a whole series of horizontal wells in and around that core asset.
Yeah.
They hit some headwinds with COVID, and as you know, natural gas prices in the US are a little bit challenging then and continue to be to date, which is why I moved over with Chris about 3 years ago to work for CanCambria. At that point, I learned quite a lot of the key performance drivers in Pinedale, and looking through his portfolio, the assets that he was particularly interested in pursuing, this Kiskunhalas project really stood out as having a lot of the key technical metrics to be successful.
Yeah, and Kiskunhalas is located in Hungary, so
correct.
We are
now
so going to Europe with CanCambria.
Kiskunhalas being in the heart of Europe is an entirely different entity in terms of market, gas price, etc. So that was part of the story, was leveraging some of the lessons learned at Pinedale, some of the key drivers, and applying them in the Hungarian tight gas space.
as very experienced developers and explorers in the gas industry. So why did Kiskunhalas in Hungary? Why did this project stand out so much that you said, okay, this is going to be the next big thing you want to pursue?
We have a few pretty stringent screening tools that we leverage when we look at assets. First and foremost, we're not into rank exploration. We don't want to go into a basin wondering if oil and gas is present. We don't want to drill a whole series of wells and dry holes in the search for hydrocarbons. So the very first screening tool is be in a basin that has oil and gas production. So we want to be looking at those, what we call mature petroleum provinces, where we know the oil and gas is in place. That's the fundamental entry for us. And then really three key criteria. The first is the asset, a high quality asset, and we can expand upon the Kiskunhalas project, but that is the company maker, the fundamental quality asset that we can discuss. The two other parameters that are also very important: access and market. The access is, it's not just geographical in terms of being able to get into a location and drill a well. It's, for a company of our size, it's the ability, the cycle time, the ability to, come into a play, acquire data, characterize, and then drill wells and bring on production in a meaningful time frame. And a meaningful time frame for us is, 2.5 to 3.5 years. And we're a good ways along in that timeline with Kiskunhalas. It's important that we have supportive regulatory and government support. Hungary is very pro E&P activity. We acquired a 3D survey last year, and that took just several weeks to permit and plan. Very good place to operate. And then the third parameter, market. We have infrastructure in place. It's an oil and gas hub for many, many years. And we also have, as very strong commodity prices in Europe, unlike the US.
And we need the gas. So we need some development over here. Yeah.
That's right.
Just buying the LPG like from the US, it's not gonna do it.
Exactly. And we were looking at, really in Hungary, a project that is large and scalable. We don't want to operate a field which is 1 or 2 wells. We want running room to drill. The project we see is maybe as many as 50 wells a decade of drilling, a significant resource base. So a lot of the legacy wells that were drilled collected some really interesting data. All of that data collectively plays into the resource estimates that are part of our prospectus, and we have a multi BCF resource base that supports development drilling.
Before we jump further into the project particulars, so just tell us, what is tight gas? What are we looking for?
Yes, tight gas. You hear the term, I'm sure, in and around the industry. It really just refers to reservoir rock which is slightly poorer quality than what would be considered a conventional high quality reservoir. So the storage is related to porosity, the pore spaces within the rock. The porosity in tight gas is a little bit lower. The ability for the fluids to come out of the rock to be productive is mainly driven by permeability. And in these tight systems, permeability is markedly lower than the conventional assets. Tight gas is, is in Hungary in particular, there are a lot of favorable attributes for tight gas. Probably the most high profile is the net royalty interest. Given that these reservoir systems are a little bit more challenging to produce, we get to keep 98% of the product that we produce. There's only a 2% net royalty interest, which is unheard of, across the industry. Any place that I've worked,
What I find interesting in oil and gas, particularly, is that the drilling holes you do, it's not like in conventional metals mining that these are confirmation holes for the materials inside, but it can be producing holes, producing wells eventually. Is that right? That can lead to near-term cash flow for the company.
Yeah, so the other attributes of tight gas that are important, rather than just a single accumulation with a fluid contact, quite often these tight gas systems they're continuously charged. You'll hear the term continuous resource, and certainly that's the case in Kiskunhalas. We have a large fault block, which is gas charged from the bottom right to the top over around 1,000 meters. Typically also have very high pressures, and we like the high reservoir pressures because they give us a very strong early production rate, so really good deliverability.
Yeah.
So we have wells that come on extremely strong, and over time they flatten out, but we get a very nice payout in terms of gas and oil production early in the life of the well, and these wells typically pay out in less than 18 months. There's an old saying in terms of oil and gas where you don't find oil and gas in old areas with old ideas. We're in a mature old area in Kiskunhalas in southern Hungary.
New ideas.
We need new ideas, right? New ideas, new technology. We need to think a little bit more innovatively in terms of we drill a little bit more challenging, a bit high temperature, higher pressure. We go just a little bit deeper. And we see the legacy data set in Kiskunhalas, the 3 older wells, as a really what we call a smoking gun. All the attributes for a really highly prolific tight gas play are present. But many people over the years, especially when prices were lower, didn't recognize that same opportunity. And I think that gives us a competitive advantage. We knew what the risks were going in, and we were able to a large extent de-risk most of those. What we did recognize was the need for a new 3D seismic survey in the area, which we funded ourselves, and that leads into some of the activity really over the last 12 to 18 months.
Yeah, I was going to ask about that. So what have you done so far?
Yeah, so the desktop study that we did in early 2023, a lot of the feasibility and a lot of the technical work, it told us there was a significant amount of oil and gas in the ground. It also told us that the well results to date were somewhat inconsistent, and we couldn't really calibrate those well results with the existing data set. There was older, really poor quality 3D seismic in the area. So we went in and did a feasibility study for a new 3D survey. The results of that were really exciting. It told us that we would be able, with a new high-spec design survey, to image the reservoir maybe down to 15 to 20 meters. And that's at a depth of 4 kilometers. So the new data set was really important to de-risk the distribution of the reservoir. So we funded that privately before we went public. We acquired a new 3D survey in December of last year. So we were on the ground in Hungary this time last year, acquiring that 3D over about a 3-week period. It was a fit for purpose design. What I would say is some of that technology is new. A lot of the technology was not available, several decades ago when some of these original wells were drilled. And even maybe 5 to 10 years ago, that technology was probably not available to a company of our size.
Yeah.
The technology, the computing power, the processing power has really been a step change for us in a relatively cost-effective way to de-risk this large play.
I find that amazing. So as you touched on it, so traditionally it's the big oil companies like being able to do this and do the data analysis and the actual work. And now we have a fresh issue. So CanCambria has been public like for a very short period only. It started at 25 cents. Now we are at 70 cents already, and the market cap is still like 68 million. Yeah, and I think investors are starting to realize that this could be a really, really big asset. So we can't go too much into detail about the real scope here. Yeah, but so what are you looking forward to do for 2025 to prove that scope and make money for investors?
Right. It's a really simple story. We need to get our first well drilled. The second half of next year, we have, as a function of the seismic workflow, we have a whole series of locations. So the first location is permitted. The planning is really almost complete, and we hope to spud that well. There's, we have a news release going out here shortly that details some of the technical work that went into selecting those initial well locations. There's a type well for the field that we used for our resource assessment. The easiest thing for us to do would have been to simply twin that well and drill maybe a few tens of meters away from that legacy well. In fact, what we're doing is we're drilling around 500 meters away from that well based upon the seismic. The seismic indicates to us areas with much more superior reservoir quality, even away from our best legacy well. So we positioned our new wells to take advantage of those, what we call sweet spots, those areas of the field that look like they have the best storage and the best deliverability. So in terms of the well, we're looking for three things. We're looking for an operational success, meaning we get the well drilled per plan to the depth that we want, on time, without incident, and within our budget. So that's the first criteria. We're looking at the second criteria being a technical success. We are able to acquire logs through the section of interest to demonstrate that we have the storage so we can update our resource maps. And then, most importantly, a commercial success, meaning we get the well on production, have it completed, and we start to understand the drainage area of each individual well, the rates that we get, the decline behavior, so on and so forth, so we can iteratively improve our model, our subsurface model, to refine the number of future locations. Tight gas is good because after you drill those initial wells and you prove up the commerciality, many of those follow-on locations are really low risk, and they're quite repeatable in terms of the reserves. We're not dealing with a consistent fluid contact, so we've got a nice thick column of rock that we can attack with these vertical wells.
And what I touched on before, like my understanding of oil and gas, so will there be potential cash flow coming to the company, or is it all exploration and development going forward?
No, that's the nice thing about the project. In the 2 to 3 well initial appraisal should pay out within a year to 18 months. The development plan, whether it's a one rig or a 2 rig program, whether we accelerate the production in a success case, we'll be living within cash flow very quickly. The project is self-funding within 2 years in that regard, certainly within 3 years.
Yeah.
In a 1 rig case. So there's, it's a pretty attractive investment opportunity pre-drill, right? We're in this pre-drill phase where we consider that we've largely de-risked the main technical issues that were prevalent in the field, and then we open up the fairway for a whole series of strategic longer-term drilling campaigns.
Excellent. I would like to ask about differentiation. Maybe you can help us. So there are some smaller oil and gas stocks around there listed at ASX and TSX, especially in Europe. So what differentiates CanCambria from maybe other oil and gas companies?
Yeah, good question. I'd say first and foremost, it's the asset. We screened a lot of opportunities in Europe, and this particular asset is head and shoulders above most of the other assets that we looked at. So, an asset that's essentially proven with a significant degree of running room, that's the first check mark. The second is the team that we assembled. We have a track record of adding value organically. We're a small, motivated team. We build fit for purpose solutions. We're not trying to over-engineer anything. We don't have any bureaucracy, so to speak, and we can let the data guide the decision making that we do. And I'll draw on an analogy from the US, where if you look back at the unconventional success that companies enjoyed in the US, almost all of it was from small and medium-sized independents. Now those companies certainly grew as a function of their success, but the larger companies certainly were not able to assume the risk and have the appetite to kind of pivot within a project. So those larger entities were not successful in the unconventional space. So we bring a lot of experience to bear on the asset. And then, finally, it's timing, right? We're in a cycle where natural gas prices remain strong. The outlook is strong, and there's certainly demand domestically in Hungary for natural gas since they import such a lot of that product. We also, I hadn't really mentioned it, but there's a liquids component to this gas. It's a wet gas. We have a significant amount of condensate, which to some extent buffers the price volatility we may see, in the natural gas space. The condensate, for example, we're looking at each well delivering many thousands, hundreds of thousands of barrels of liquid in addition to gas. So yeah, we have a really good recipe in terms of asset, people, location, and timing. So yeah, we're extremely excited for the next 12 to 18 months.
Excellent. Thank you so much, Paul, for this interview. Don't sell it all to Hungary, leave some for Germany. And so this was Dr. Paul Clark of CanCambria Energy. And if you want to look up the stock, do so. It's listed on the TSX Venture Exchange under the symbol CCEC. And we are, of course, going to cover it on Mining Scout constantly. So pleasure to have you, Paul, and thanks so much.
Thank you. Appreciate it.